If you think buying gold right now is the safest move, you might be walking straight into a trap. Because while the headlines scream about a gold rally, and everyone's talking about how it's the only safe asset left, the smartest investors in the world are quietly doing something very different. See, this isn't the first time we've seen a gold rush driven by FOMO investing. Every decade or so, fear takes over logic, and people repeat the same behavioral finance mistakes. Buying not because something is undervalued, but because everyone else is buying it. And that's where the psychology of gold becomes dangerous. It feels safe, it feels timeless. But the rich know that's exactly what makes it risky. Because when emotion replaces reason in the market, that's when wealth quietly changes hands. So in this video, we're going to break down what's really happening behind this 2025 gold rally. The hidden signals that most investors are missing, the psychological traps driving the hype, and most importantly, how the rich are protecting themselves while everyone else is falling for the glitter. Because as Warren Buffett once said, the market is a device for transferring money from the impatient to the patient. And right now, that couldn't be more true for gold. See, when you scroll through finance news right now, every headline sounds the same. Gold hits new all-time high. Investors flock to gold amid uncertainty. Central banks continue record gold purchases. It creates a feeling of inevitability. Like if you're not in gold, you're missing out on something big. But here's where it gets interesting. This kind of emotional wave isn't new. In fact, it's one of the oldest behavioral patterns in financial history, and the rich, they know how to read it like a book. Let's go back for a second. Whenever gold enters a major rally, three emotions start dominating investor psychology: fear, safety, and envy. Fear of losing money in volatile markets, the need for safety during economic tension, and envy, the most underestimated one, the feeling of watching others profit while you stay on the sidelines. Those emotions together form the perfect storm for FOMO investing. It feels rational because everyone's talking about macroeconomics or inflation or debt, but underneath it's pure emotion disguised as logic. Behavioral finance calls this the rationalization loop. You start believing a story because it feels emotionally true, not because it's factually sound. Now, when we apply that lens to gold today, the signs are clear. Retail investors, that means normal people, not big institutions, have been buying record amounts of physical gold ETFs and coins since early 2025. But here's what's even more telling. Institutional players are quietly selling into that strength, the same way they did in 2011, the last time gold peaked above $1,900 an ounce. Back then, everyone said this time it's different. It wasn't. Prices corrected 40% in 2 years. What changed was only the narrative, not the math. And that's exactly what's repeating now. The narrative says gold is a hedge against chaos. But if you look at actual historical data, it's not always true. During several past recessions, gold underperformed cash and even bonds. Yet investors continue to treat it as a guaranteed insurance policy. Why? Because of a bias known as availability heuristic. Our minds overvalue the things that are easiest to remember, like gold rising during 2020 or in the 1970s. We forget the flat decades in between. Rich investors, however, are trained to question those easy narratives. They ask, what's the context? What's the valuation? And who's buying? Right now, that who is mostly emotionally driven buyers. People reacting to debt headlines, inflation fears, or AI bubbles. But the ultra-wealthy, they're quietly diversifying into assets that benefit from gold hype rather than following it. They buy mining royalties, they short overvalued gold ETFs, or they move into sectors that attract the same fearful money flow, like energy or commodities that still trade below intrinsic value. It's not about rejecting gold, it's about recognizing when the crowd has priced in perfection. Look closer and you'll see another subtle clue. Google searches for how to buy gold have doubled since March 2025. YouTube channels promising the coming collapse have spiked in views. Social media influencers are suddenly gold experts. That level of retail excitement has historically marked late-stage rallies in every asset class. Whether it was crypto in 2021, real estate in 2007, or tech in 2000. The rich don't see this as bullish. They see it as a signal of exhaustion, because the moment the average investor starts chasing, smart money starts exiting. But there's an even deeper psychological layer here. Safety illusion. Gold makes people feel like they're avoiding risk, but the truth is they're just choosing a different kind of risk. Price risk instead of inflation risk. Liquidity risk instead of volatility risk. The rich understand this trade-off. They don't see gold as safe, they see it as sentiment sensitive. meaning its price depends less on fundamentals and more on collective emotion. That's why they track sentiment data, fear indexes, and ETF flows, not just spot prices. If you compare those flows right now, you'll find something fascinating. Retail inflows into gold ETFs are at a 5-year high. Meanwhile, central bank buying, which was the big story in 2024, has quietly slowed down. So the buyers that created the narrative aren't the ones sustaining it anymore. That's usually when things turn. Because when institutional liquidity exits, what's left are emotional investors holding the bag. This is the first hidden signal of the gold trap. Emotional overconfidence disguised as safety. It's not that gold itself is bad, it's that the mindset around it has shifted from cautious hedge to blind faith. And in behavioral finance, when faith replaces analysis, the correction is only a matter of time. The rich know this. They wait patiently as retail investors chase what looks like stability. And when the crowd finally realizes that safety was just a feeling, not a fact, that's when opportunities quietly transfer back to the disciplined few. So before jumping into the hype, it's worth asking, what if the real danger isn't missing the rally, but joining it too late? Because in markets, just like in life, the price of certainty is often paid in regret. Now that leads perfectly into the next stage of this gold trap, the illusion of value. Because while everyone's looking at gold's rising price chart, very few are looking at what's actually holding it up. And what you'll discover next is how the data, the global economy, and even the way we think about value itself might be setting investors up for a massive surprise. See, gold's biggest strength is also its biggest psychological trick. It doesn't produce anything, it doesn't generate cash flow, and it doesn't innovate, but it feels valuable because we've been conditioned for centuries to see it as money. That emotional association is powerful. It's baked into our culture, our history, and even our language, worth its weight in gold. But here's the reality the rich understand. What gives gold value isn't intrinsic, it's collective belief. And collective belief can turn fast, especially when it's fueled by fear instead of fundamentals. Let's look deeper. Right now, gold is trading at record highs in 2025, but not because production costs suddenly doubled or because the global supply dramatically dropped. It's because demand has been artificially inflated by panic. Investors worried about inflation, about debt, about geopolitical tension, they're all rushing into the same small doorway at once. And that demand spike creates the illusion that gold is undervalued or that it's responding to real economic signals. But most of the movement is sentiment-driven, not structural. And the rich? They know how to read these disconnects. They track the real yield spread. That's the return on inflation-protected bonds minus inflation expectations. And whenever that spread narrows, gold tends to rise because it's seen as an alternative to low-yield assets. But here's the twist. That spread has started to widen again, meaning the actual economic data no longer supports gold's current price. Yet retail investors keep buying because they're anchored to the recent rally. That's the illusion of value, when price momentum blinds us to changing conditions. Another clue the rich watch is central bank behavior. Last year, headlines said, central banks are buying gold at record levels. True, but what got buried in the details was that those purchases peaked months ago. Since the second quarter of 2025, net buying has slowed sharply, and some countries have even started selling to rebalance reserves. But retail investors missed that shift because they only read the headlines, not the updates. It's a subtle moment when smart money steps aside and emotional money steps in. And it's not just macro data, even micro patterns show cracks. Mining companies, which typically move with gold prices, aren't showing the same enthusiasm. Their stock prices have lagged despite higher gold prices. Why? Because insiders, the people running those companies, have been quietly selling shares. When insiders sell while the public buys, it's usually a tell. It means they know the margins, the production costs, the realities behind the glossy price chart. The rich follow insider transactions like a compass, not media headlines. This entire cycle mirrors something we've seen over and over in behavioral finance: narrative inertia. Once a story gains momentum, gold is safe, gold always rises in chaos, gold is real money, it keeps running long after the data stops supporting it. Investors cling to the narrative because it feels comfortable, and comfort in investing is often a trap. The rich, however, deliberately seek discomfort, the assets nobody wants when fear is high, and the opportunities nobody notices when greed takes over. Think about this. In 2011, gold hit a record around $1,900 an ounce. The narrative was identical: high inflation, weak dollar, global uncertainty. Then what happened? Inflation cooled, the dollar strengthened, and gold prices fell nearly 40% over the next 2 years. Retail investors held, convinced it would rebound. It took nearly a decade just to get back to the same price. The rich didn't wait. They rotated out before the top and redeployed into undervalued equities while the crowd was still hoarding gold bars. That's how wealth quietly compounds, not by chasing the crowd, but by stepping aside before the stampede. But let's go even deeper into the psychology behind it. Behavioral scientists talk about confirmation bias, our tendency to seek information that supports what we already believe. Right now, anyone bullish on gold can find thousands of posts, videos, and articles confirming their belief. The dollar is doomed. BRICS will replace the US currency. Fiat is collapsing. It all sounds urgent and rational, but it's curated content. Algorithmic echo chambers reinforcing emotion. The rich protect themselves from this bias by constantly asking, what would prove me wrong? That question alone separates disciplined investors from emotional ones. And when they analyze gold through that lens, they see an asset priced for perfection in an imperfect world. Global GDP growth, though slow, hasn't collapsed. Inflation is moderating in several major economies. The US dollar, despite endless bearish predictions, remains the world's reserve currency. Yet gold continues rising, not because of fundamentals, but because of perception inertia. When people believe something is valuable, they keep buying it, assuming others will too. But that belief can break overnight once reality reasserts itself. There's also a fascinating paradox here. Gold shines brightest when trust in everything else fades. But trust can return faster than fear fades. And when that shift happens, the same crowd that rushed into gold rushes out, creating violent price swings that punish latecomers. The rich, aware of this, use volatility as an opportunity, not a threat. They don't panic when gold falls. They patiently accumulate when others are dumping, not when it's making headlines. Let's connect this with the deeper framework of behavioral finance. Every asset class has what psychologists call a story premium, the extra price people pay for emotional comfort. In tech stocks, that premium comes from innovation excitement. In real estate, it's from tangible ownership. In gold, it's from perceived safety. But the rich know how to strip the story away and look only at the math. What's the opportunity cost? What return am I foregoing by holding gold instead of productive assets? When that math no longer adds up, they pivot, quietly, rationally, without emotion, and that's exactly what's happening right now. While retail investors are increasing their gold exposure, the portfolios of ultra-high net worth individuals show a shift toward productive assets, private credit, infrastructure, undervalued equities. They're moving away from static stores of value toward assets that create value, because they understand something most don't. Wealth doesn't just sit, it compounds. So the illusion of value around gold isn't about price, it's about psychology. The price might be real, but the reasons behind it aren't. And once those reasons lose credibility, when inflation stabilizes, when fear fades, when investors remember that cash flow matters, gold's aura of inevitability cracks. And when it does, the same people who felt safe will be the ones feeling stuck. Because gold doesn't crash like a stock, it drifts down quietly, month after month, while attention shifts elsewhere. By the time the crowd realizes it, the rich are already 3 moves ahead, rebalancing into the next undervalued sector. That's the quiet game of wealth, seeing value where others see fear, an illusion where others see safety. Now this brings us to the final stage of the gold trap, the transfer of wealth. Because every bubble, every rally, and every emotional cycle ends the same way. Money doesn't disappear, it just moves from the impatient to the patient. And in the gold rally of 2025, that transfer might already be happening right under everyone's nose. The transfer of wealth isn't a metaphor. It's an invisible handover, from the emotional investor chasing certainty to the strategic investor creating it. And it happens quietly, often while the majority still believes they're winning. Here's how it unfolds. During every major gold surge, retail investors enter late. They see prices climbing, social media buzzing, news anchors calling gold the ultimate hedge, and they rush in thinking they're protecting themselves. But the smart money, the ones who bought when nobody cared, are already exiting. They're not emotional. They understand cycles. They know that when something becomes a sure thing, it's no longer an opportunity, it's a trap. Right now, that's exactly what's happening in 2025. Hedge funds and institutional players are scaling back gold positions quietly, while retail demand spikes to a multi-year high. You can literally see this in the data. ETF inflows are up sharply from small investors, but the total institutional holdings have flattened. That's the inflection point where money starts shifting hands. The wealthy aren't against gold, they're just trading people's emotions. This is what economists call the liquidity inversion. When the buyers left are emotional and the sellers are strategic, it's like musical chairs. As long as the music plays, everyone feels safe. But when the beat stops, someone's left holding the bag. And it's rarely the ones with private analysts, data access, or disciplined exit plans. The rich prepare for this transfer months in advance. They use derivatives to hedge gold exposure, so even if the price dips, they profit on the downside. They diversify into assets that benefit from a cooling gold market, like treasury bonds or sectors tied to industrial recovery. Meanwhile, retail investors double down, buying the dip, thinking it's temporary. But by the time the emotional money stops buying, the price correction becomes self-reinforcing. Sellers outnumber buyers, momentum breaks, and the illusion fades. This wealth transfer is subtle but ruthless. Let's take an example. During the last major gold correction in 2012 to 2013, gold dropped around 28%. Retail investors lost billions in unrealized value, while big players shifted into equities and made enormous gains over the next few years. The lesson? Every emotional rally creates someone else's opportunity if you understand the timing. But here's what most people miss. The rich don't measure success by timing the top. They measure it by managing risk. They don't care if gold goes from $2,300 to $2,400 before falling. They care that when the fall happens, they're already out, emotionally and financially. That detachment is their edge. They also think in terms of real yield, not nominal return. While most investors see gold as beating inflation, the rich compare it to the yield on inflation-protected securities or the return from dividend-paying stocks. If those assets start offering higher real returns, gold instantly becomes less attractive, and they move. Retail investors, on the other hand, stick around because they're attached to the narrative, not the math. And this is the cruel irony. Gold feels safest at the peak of danger, but that's when it's most dangerous. When the crowd feels panic, gold feels like a refuge. But when the panic fades, gold feels like a burden. The rich anticipate that emotional cycle and position themselves to profit from both ends, fear and relief. Now, this doesn't mean gold is useless. The rich still use it, but strategically. They hold it as an insurance layer, not as a growth asset. Maybe 2 to 5% of their portfolio, not 50%, because they know gold's job isn't to make you rich, it's to protect wealth during chaos. And when chaos calms down, you don't hold on to insurance, you redeploy it into opportunity. Meanwhile, retail investors confuse safety with stagnation. They hold too long, waiting for the next surge. But markets evolve, narratives change, and eventually capital that sits idle loses purchasing power. The rich rotate it, like chess players thinking 5 moves ahead, while most are still reacting to the last move. This cycle, the fear, the FOMO, the illusion of value, and finally the wealth transfer, is as old as markets themselves. And in 2025, gold just happens to be the latest stage. The players are the same, just the headlines have changed. The winners will once again be those who kept their heads when everyone else was losing theirs. And maybe that's the biggest hidden lesson of all. Wealth isn't about spotting opportunity first, it's about resisting emotion longest. Because when everyone's chasing gold, the real treasure is patience. Gold might glitter, but wisdom outshines it every single time. Because the truth is, every generation faces its own gold rush moment, a time when fear and excitement blur the line between logic and emotion. But those who build real wealth, they don't chase what shines, they study what lasts. So before you buy into the noise, pause for a second. Ask yourself, are you investing out of strategy or out of fear? Because fear feels safe until it costs you freedom. And freedom is what real wealth is made of. Maybe the smartest move right now isn't to stack more gold, but to stack more knowledge. Learn how money actually flows. Understand cycles. Build conviction that doesn't shake every time the market does. That's what separates the rich mindset from the reactive one. Because gold can protect your money for a moment, but wisdom can grow it for a lifetime. If this video helped you see the gold hype in a new light, hit that like button and share it with someone who's chasing the next safe bet. Because sometimes the best protection isn't an asset, it's awareness. And remember, in every gold rush, the real winners weren't the ones digging for gold. They were the ones who sold the shovels. Stay smart, stay patient, and I'll see you in the next one.